it's kind of fun when, gold was breaking out and breaking out and breaking out. We had lots of gold headlines, and we talked about how that might bring more generalist investors in. It's sort of fun, but also a little bit scary to see silver headlines on CNBC or Bloomberg. There was a video that went around a couple of days ago about, will silver head higher? And it wasn't silver or gold bugs. It was one of these mainstream media outlets. I forget which one. But the funny thing is it allows anything new, anything we hadn't heard already about the shortage in London of physical and people flying silver around, all that sort of stuff that we've talked about for weeks now. But people got all excited and people want to know, what do I think about this video and so on? Well, I think they're telling us what we already know. But to answer the question, I think I have two minds on this. On the one hand, I'm long, and despite people calling me Darth Silver and all these things, I own plenty of silver stocks. I'm very happy to see it long. I've never been a bear. I'm not sure I really want to see silver catching up with gold because, even your most diehard silver bulls will tell you that silver lags gold at first in a bull market and then more than catches up at the end. It's not the catching up part I have a problem with. It's the end part I have a problem with. My analysis is not technical. It's fundamental. And I don't see any reason for this bull market. I'm bullish on anything real that governments can't print. I'm particularly bullish on monetary metals, safe haven assets. If you, dear audience, think that the AI valuations in the market are a bubble, if that bubble pops, I think that would create a lot of demand for safe haven assets. As we all know, if the market actually crashes, I'm not just talking, rolling over and politely, slumping down to more reasonable valuations. If there's an actual crash, everything gets whacked, absolutely everything, including gold at first during that initial liquidity crunch, and then it goes soaring. If that happened for anybody who gets it, that could actually be an absolute gift on the part of the market. That sphincter's opening moment, like in 2020 or 2008. I wasn't in the market in 1987, but I understand it was a similar thing, right? The wrong things go on sale, and that is an absolute, the best times you could have bought gold in my career or during the crash of 2008 and the flash crash of 2020. Both of those saw screaming rebounds afterwards. So we might see something like that if the AI bubble bursts. And if not, broadly speaking, I think the writing is on the wall of the inflationary agenda in the United States. Even if you agree with Trump, the votes did not save us $2 trillion. The tariffs are being walked back and negotiated down. So I think the agenda is highly inflationary. Europe's rearmament is highly inflationary. Russia's war is highly inflationary. Even China, at long last, has finally got some consumer price inflation going again. So, that's bullish for monetary metals. And then to sort of the not just the geopolitical risk, but the awareness of how rickety the financial house of cards has gotten. I think, I can't prove this, but I think it has a lot of mainstream investors, deep-pocketed, not just institutions, but individuals, family offices, that sort of thing, saying, maybe I should hedge with a bit of gold and maybe some silver too. So all of this is very bullish, whatever happens long term. And I feel a bit odd saying this when we're at or near record prices in gold and silver, but there's actually not a very strong case for gold going down. The strongest case we could have made recently was, gold went screaming up to 4,400. That was too fast, and it has to be a correction. And then the question was, would that be a peak or would it be a plateau to another high later? And I wanted it to be a plateau, but Mr. Market doesn't care what I want, right? So we had to see. And I think it's pretty evident right now. It certainly wasn't this kind of peak. It wasn't a 1980 intraday type peak. It looks like 4,000 is the new 3,000, and we're consolidating before moving higher. So overall, bullish all around. It's a crazy thing for me to say at these levels, but that's the way I see it. And sorry, let me come back to the point of your question. If I'm bullish on gold and I'm bullish on anything real, how can I not be bullish on silver, right? That having been said, if I'm right in my fundamental analysis and that we still have a long way to go with this market, then that argues for actually silver cooling off a bit here. Maybe it kisses 60, that sparks some profit taking and it cascades a bit. But if silver crashes all the way down to 50, the silver miners will still be printing money, like literally pulling money out of the ground, real money. So I don't think that would be a disaster at all. I think to the degree that something like that put the silver stocks on sale, again, that would be an opportunity. And what might make that happen? If it's true that, demand out of India is and front running of tariffs and critical minerals rebalancing, this sort of thing, has put a squeeze on the physical markets, I think that rebalances. Again, I'm not a bear here. I'm not arguing against silver, but I think that would be a good thing. That would set the stage again for consolidation before moving higher. And if that's not what happens, if we're really at that blow off top, the good news is, okay, everything will go higher. The bad news is that whenever it, peaks, that we're likely then to go into bear mode for some time. So yeah, again, Mr. Market doesn't care what I want. I would prefer it wasn't the blow off top just yet. But if it is, if we start seeing things going parabolic again and gold confirms silver's move, then actually I would deploy more cash. As crazy as it sounds to say, yeah, I'm going to jump on all-time highs, if we're looking at that blow off top, then yes, I would put more money to work trying to profit on that. And I mean in the stocks. Bullion, I always buy on the dips. That's my savings. I'm always willing to accumulate bullion. That's not what I'm talking about. I'm talking about speculating for hockey stick gains on the stocks.
Of what's happening right now, maybe in the last couple of weeks, do you attribute to, it seems like a Fed rate cut is now more likely. It was questionable for a couple of weeks there, but now the betting markets are really saying that, we're going to get a Fed rate cut most likely in December. And also, it seemed like this leak about it's Kevin Hassett, who is likely to be the next Fed chairman. Betting markets have him over 80% chance of being the next Fed chairman. How much of that, with respect to the Fed and Trump and everything, is what's fueling the push, especially for silver higher?
I got a yes and no on that. Clearly when those things happen, the headline about Hassett came across, we saw an instant response in the markets, the broader markets, as well as gold. I don't remember silver wiggle that day, but I do remember that it was good for gold that day. And I think silver was sympathetic. But then things go back to the way they were. And at this point, that Fed rate hike, as you say, that the market's in near certainty.
There's this strange moment in every precious metal cycle where the mainstream financial press suddenly discovers silver exists. Gold they tolerate. They've been forced to respect it for 5,000 years. But silver? For CNBC and Bloomberg to run segments on silver, to debate whether it might go higher, to put talking heads on camera and act like they've unearthed some secret? That's almost comical. And yet here we are. I saw one of those clips making the rounds recently. People sent it to me like it was the Dead Sea Scrolls. They said, "Lobo, look at this. Even Bloomberg is talking about silver shortages." And I watched it and I thought, wow. They didn't say a single thing we haven't been talking about for weeks. Not one new insight. It was like watching someone discover fire in 2024. Cute, but late. This is what happens at the beginning of a mainstream rotation. First, gold breaks out, repeatedly, relentlessly, and nobody can ignore it. Then the big money, family offices, institutions, sovereign funds, start kicking tires on the rest of the monetary metals. And once silver even whispers a confirmation of gold's breakout, the mainstream comes running with headlines like, "Is silver the next big trade?" It's fun. It's also a little unnerving because every silver bull knows that silver only leads at the end. It lags gold early in a bull market, and then at the climax, it absolutely blows past gold. It doesn't catch up. It overshoots. And what comes after that overshoot? The end of the bull market. Look, I'm long. Anyone who calls me Darth Silver online has obviously never seen my portfolio. I have plenty of silver stocks, and I'll happily add more. But if you ask me whether I want silver to suddenly outperform gold by a massive margin right now, no, because if it does, that means the clock on this bull market starts ticking down fast. So the irony is, I'm bullish, but I'm also hoping silver cools off a bit. That's the paradox of being a realist in a market full of hopium addicts. My analysis isn't technical, it's fundamental. I don't sit around waiting for Fibonacci levels to align with retrograde planetary charts. I look at things governments can't print: real assets, real money, real commodities. And when I connect the dots, AI valuations that are clearly frothy, geopolitical tensions escalating, inflation refusing to die, sovereign debt exploding, a fiscal stance in the US that's more YOLO than the Roman Empire before it fell, I can't help but be bullish on monetary metals. Here's the thing: if you believe the hype around AI, you also have to accept the risk of an AI bubble popping. And if it pops, it will be the same story every time. In a real crash, everything gets sold. Gold, silver, stocks, bonds, crypto, doesn't matter. Margin calls force liquidations. The early phase of every crash looks like the apocalypse. And then gold and silver rip higher as the fear shifts from liquidity to solvency. It happened in 2008. It happened in 2020. In both cases, the people who stepped in during that sphincter tightening moment walked away with some of the biggest wins of their careers. Let me put it another way. The wrong things go on sale during a crash. When the fire alarm goes off, the market throws the baby, the bathwater, and the bathtub out the window. And that's exactly when the patient, informed investor, someone not staring at the S&P like a lab rat waiting to be fed pellets, steps in with both hands. But even without a crash, the macro backdrop is relentlessly inflationary. Even if you believe Trump's claims about saving trillions, even if tariffs get negotiated down, even if the next Fed chair is someone calm and orthodox, nothing changes the underlying math. The US fiscal trajectory is inflationary. Europe's rearmament is inflationary. Russia's war is inflationary. China finally printing stimulus to revive consumption? Inflationary. This is not an environment where monetary metals roll over and die. This is an environment where they consolidate before making another sustained move higher.
We are approaching the end game. I've thought we've been approaching the end game since 2008. So either, no, not in 2008. I was just waking up back then. But, what's the timeline? I don't know. I've been wrong about this so many times, but I mean, gold and silver are moving so quickly in both directions. The volatility is increasing. And the last piece of news that I saw is that whatever their Congress is called, is set to pass a law or a suggestion or some kind of statement that the gold that's owned by the Italian central bank, which is now subservient to the ECB, but it used to be independent of the ECB, that the Italian gold now belongs to the Italian people. And then the ECB is like, we're strongly encouraging you to not say that. And then the funny thing is that they're damned if they do. I'm talking about the ECB, damned if they do, damned if they don't, because if they say, no, you can't pass that, or if they express any kind of strong opinion other than that, we strongly suggest that this is not a smart thing. And then in the article I read on Reuters is like quoting some ECB official saying, I don't even know what this means, but we discourage it anyway, because they have to pretend that they don't care about gold, but at bottom they know that it's what's backing them.
Right.
So if each country takes ownership of its own gold and hollows out the ECB in that way, it's basically what I'm preaching on the Endgame Investor. It's like you stack gold and silver, not necessarily to make yourself rich or even to get through the end game or to make sure that your family's okay. All that is a side effect, and it's a good side effect. It's a welcome side effect. But
right.
The point is we want to hollow out the system because we don't want them to be able to inflate and spend money on lockdowns and pharma subsidies, maybe in 2013, 2014, something early on.
Mm-hmm.
And Italy is a basket case. They have like the second highest debt to GDP in the world, I think. Maybe third highest, I think, is Japan, and then Greece, and then Italy. I think they have the third or fourth largest gold hoard, right? So once you see legislatures start to pay attention to gold and declare that they own it instead of a central bank, we're really getting to the core of the issue here, because as we say, gold and silver are money. The only problem is people don't want to admit it. And so they say, oh, it's just a hedge against inflation, or it's a way to protect yourself from tail risk, or it's a way to protect yourself from chaos. But like, why is that? Why is it a hedge against inflation risk? Why is it a way to protect yourself? Because it's money. Because but you say that, you can say that over and over and over again, and it doesn't click until everybody starts seeing the value of their credit falling and falling, and they realize, well, this isn't money, it's not working, so I have to go back to money itself. And no matter how many times you say it, it's like you can only understand it instinctually. Right. Understanding it intellectually is one thing, but even if you could prove it, and I try to prove it, that's why I focus on the Misesian regression theorem or regression principle, that all prices have to go into the past, because they all have to be based on the past, because otherwise prices don't mean anything. And if prices don't mean anything, you may as well be in a zombie apocalypse, because if prices are meaningless and nobody knows what to do, and then they start eating each other.
Picking up from where we left off, the question hanging in the air is, how much of silver's current surge is the result of shifting sentiment around the Fed? And how much is deeper, structural, irreversible, and tied to forces far older than Powell's printer? The truth is, it's both. Markets live in the short term and the long term simultaneously. The short term gives you the wiggles, the headlines, the mini panics when Fed watchers misinterpret a comma in Powell's speech. But the long term, that's where the conviction money lives. And right now, long-term forces are aligning in ways we haven't seen in decades. Before I get into those forces, let me finish the Fed point, because it matters more than people think. Yes, the betting markets have priced in a near certain December rate cut. Yes, the leaked chatter about Kevin Hassett becoming the next Fed chair sent a ripple across financial media the way a dropped French fry sends pigeon scrambling. And yes, anything that signals easier monetary policy accelerates gold and silver's momentum. But if you zoom out, the signal behind the noise is simply this: the financial system cannot handle tight money, period. The US government cannot afford to service its debt at normal interest rates, not even close. Corporations dependent on rollovers can't survive. Consumers swimming in revolving credit can't survive. Banks stuffed with long-duration paper can't survive. It's not a question of whether the Fed wants to cut rates. It's a question of needing to keep the lights on in a system that can't function without artificially cheap debt. And once you see that clearly, everything else, the noise, the leaks, the debates, becomes background chatter. So when silver jumped on Hassett headlines? Sure. When gold popped on rate cut probabilities? Sure. But the real driver is the collective understanding, growing louder every month, that the Fed is painted into a corner, and no amount of PR polish can hide the scuff marks. But let's step away from the Fed for a moment, because monetary metals don't need Powell to justify their strength. They need something far more basic: demand outpacing supply. And that is exactly what's happening. If there is one point I wish every investor understood, it's this: markets don't move because investors want them to. They move because the fundamentals force them to. And right now, industrial silver demand isn't just growing, it's exploding. Solar panel manufacturing alone is consuming silver at a rate that was unthinkable 10 years ago. EVs require far more silver per vehicle than traditional cars. High-end AI servers, 5G infrastructure, advanced water purification, silver is baked into all of it. And here's the kicker: while silver demand keeps growing, many silver miners remain starved for capital. Why? Because generalist investors don't understand silver. They understand NVIDIA. They understand Tesla. They understand whatever their neighbor bought last week. But ask them about declining ore grades, epithermal depletion, or silver's byproduct dependency, and you might as well be speaking Klingon. That's why this market is being driven by physical tightness, not speculative froth. When I look at COMEX, open interest hovering near oversold levels, at a time when silver is blasting through multi-decade resistance, it tells me that this is not a spec-driven rally. This is a structural imbalance expressing itself in price. And the establishment shorts? They're starting to choke on their own hubris. Think about the psychology on that side of the trade. For years, decades, being short silver was like owning a printing press. The industrial producers and bullion banks assumed they could always paper over physical demand with unallocated contracts. They assumed nobody would stand for delivery. And to be fair, for a long time, nobody did. Rolling contracts was the norm. Standing for delivery was a novelty. But that era is ending. Now, when a player stands for delivery of nearly $2 billion worth of silver in a single session and refuses cash settlement, every alarm bell in the building goes off. That's not a retail investor with a Robinhood account. That's not a YouTuber stacking eagles in their basement. That's sovereign-level money. That's family office-level money. That's someone who does not trust the system to function 6 months from now unless they get their medal today. And when that happens at the exact moment, the CME claims a cooling failure that somehow affects only the precious metal servers and none of the other CME markets. You'd have to be pathologically naive to take that explanation at face value. Cooling failure? Please. These data centers have double redundancy, sometimes triple redundancy. They're designed to run through everything short of a comet impact, and yet somehow, the metal servers alone overheated during a thinly traded overnight session? On the exact night silver broke through $54 in Asia and the December contracts hit delivery lock? If this were a movie script, the producer would throw it out for being too obvious. But this is real life, and real life is messy, political, and opaque. The more important takeaway is not the glitch, it's the desperation behind it. Paper claims are colliding with physical scarcity. Delivery requests are colliding with warehouse inventories that are shrinking month after month. The LBMA already had to stretch T+1 into T+8 weeks earlier this year, blaming shortages of trucks and manpower. Right, because it takes 2 months to find a driver in London. Totally normal. Nothing to see here. This is what happens when the world wakes up to the idea that possession is 10/10 of the law. As long as everyone believes the metal is there, the system functions. But once large players realize the cupboard is getting bare, the scramble begins. The insiders move first. They always do. And right now, the insiders are loading up on physical metal like it's the last lifeboat on the Titanic. Some people ask me, Lobo, is this where everything blows up? Is this the end of COMEX? Is the paper game finally collapsing? Maybe, maybe not yet. But the pressure is building, and pressure always finds a release. Meanwhile, generalist investors, the ones the mainstream media assumes are driving the rally, are barely involved. If you look at mining indices, silver miners aren't leading this market. They're being dragged behind the physical price action like tin cans tied to a wedding bumper. Fresno, for instance, the world's largest primary silver miner, consistently lags the metal. That tells you something important. This rally is physical first, investment second. And that brings us back to the big narrative shift that's just beginning. For years, silver was treated as the schizophrenic cousin of gold, too volatile for conservative money, too boring for speculative money. But now, institutional investors are starting to whisper what silver bugs have known forever. You can't print silver. You can't conjure it out of a spreadsheet. You can't mint it at a central bank. You have to dig it out of the ground, increasingly at lower grades, increasingly as a byproduct of other metals, and increasingly in places where geopolitical stability is, let's just say, optional.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.